The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
For the equity bulls, the economic reports aren't cooperating, and so far, neither are corporate earnings. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romain Bostic.
And I'm David Gura. We are kicking you off to the closing bell here in the U.S. And the story today has been about bank earnings, of course, in the middle of earnings season, in the middle of those bank earnings as well. We see that bank earnings, that bank index there down slightly today. We see the fundamentals starting to shift here when it looks at the equity market, the way that we're seeing kind of a rotation underway here. Looking at the NASDAQ 100 down today by was 1.5%. The Russell 2000, what I've been keeping an eye on here over the course of the day as well, looking at those small cap stocks. This is the 9th day in which those small caps have risen. Then looking at the dollar index, amid so much geopolitical tension here all over the world, everyone, of course, paying attention to what's happening in Iran. We see the Bloomberg dollar index down slightly today on the news, Romain.
Yeah, the differential between the first line and that third line of your screen has been the story for some time. The back-to-back losses on the S&P today, driven by big tech once again. Microsoft, Amazon, Broadcom, NVIDIA, they're actually responsible for 50% of the point move lower over the past two sessions. But similar to recent sell-off, the money is actually still staying in this market, rotating out of tech and into energy stocks like Exxon, into consumer staples like P&G, and into small caps, particularly those that are related to minerals, defense, and space. As David just pointed out, the Russell 2000 outperforming the S&P for a 9th straight session, a bet on economic resiliency to be sure, or at least a bet that the worst economic scenarios are in the rear view. The data, though, that's still mixed. A report today showing retail sales rising in November, but downward revisions to the October numbers tempering any enthusiasm. And while consumer inflation is moderate, a separate report this morning showed wholesale inflation picking back up as energy costs continue to rise. And the potential bump from earnings, well, that's still being kept at bay for now. The disappointment investors got from J.P. Morgan yesterday, it was less about growth and more about costs. And that narrative extends into today's slate of earnings from Bank of America, from Citigroup, and from Wells Fargo, which each flagged the higher costs out there despite record or near record quarters for trading revenue, merger advisory, and loan profitability.
Now, I look at these bank earnings and what the story has remained so much focus here on what the president floated a few days ago, this cap on credit card interest rates. But another big story here has to do with net interest income, of course, so crucial to all of these banks. We've seen that rise despite the fact that the Fed is raising the prospect of cutting rates here. See that going into 2026 as well. But certainly some of these banks are going to be focused on, analysts are going to be focused on here in the months ahead, Romain.
Yeah, absolutely. Here we are going to dive a little bit deeper into some of those earnings that we got out of the banks, particularly with Wells Fargo. A bit of a turnaround story there as that company continues to try to expand its business after the regulatory shackles that had been on its wrist for years were finally removed just some time ago. Pleased to say joining us right now is the CFO of Wells Fargo, Mike Santomassimo, joining us here from their headquarters here in New York. Mike, I want to start off first with some of the growth that we saw on the loan side. Total loan growth is up. Commercial loan growth is up. Deposits were also up as well, including larger deposits. And I'm wondering if you could maybe start on that larger side of the deposit equation with regards to some of those small and mid-sized businesses.
Yeah, hey, thanks, Romain, for having me again. And as you said, we saw really good momentum continue in the quarter across the loan space. And, if you look at the credit card space, you saw, new accounts up 20% and balances up. You saw 19% increase in auto loans. You saw a good increase in the commercial bank. You saw, increases across most categories in the corporate investment bank as well. And so you're just seeing really good activity across the board. And that's coupled with good activity on the consumer side. You continue to see good spending. We're not seeing credit issues emerge yet. So we're overall a really good quarter, and we'll see how that continues or if it continues into the early part of the year.
How do you balance out the risk associated with that growth? I'm talking particularly about the 20% jump that we saw in the credit card business, 20% jump that we saw in the auto loan business. Are you comfortable right now with credit quality and the state of the consumer?
Yeah, no, the consumer has been very consistent now for a number of quarters. I feel like we keep saying this, quarter after quarter, but if you look at activity, it's really good. You look at liquidity, it's still strong. You look at, credit performance, still very strong. And you look at the growth that we're seeing, particularly in our credit card business, it's really a result of the new products that we've launched over the last 3 or 4 years. we're not expanding credit appetite, substantially. So it's really good uptake in those new products. And then on the auto side, very similar. We've been investing in that business. We added on new partners like Volkswagen and Audi, and so you're seeing really good growth there. And at this point, we're not seeing anything that would indicate that credits that good credit trend is changing in any significant way.
Mike, you bring up those credit cards, and there's been a chorus of your contemporaries talking about what the president proposed a few days ago, that cap on credit card interest rates. And I'm curious how you're thinking through that if that were to come to fruition, and maybe you could give us some insight into what efforts are underway to kind of communicate your perspective to policymakers in Washington as a result of that proposal.
Yeah, look, I think, as you think just broadly about the issue of affordability and what people are talking about, there's certainly, we share some of those concerns, and we've been, indicating that, there's been, people have been, dealing with that for, quite some time. But when you look at this idea, it will remove credit at a really important time from the people that most need it, and so there will be negative consequences across, of credit availability across the spectrum of credit card users. And so as we sort of think about different solutions on how to deal with the affordability issues, we just really need to make sure there's no unintended consequences. And in this case, I think there will be negative consequences, not just on credit availability, but also just broader economic growth. And so we'll see how it goes. But again, I think that's very consistent with you hear from the rest of the folks commenting on it.
I'm very curious. It seems like there's been kind of this disconnect between the way that markets have been reacting to policy changes the president has made. And I'm curious, as you talk to Wells clients, sort of what they say about how they understand what the president's doing, sort of what gives them agita and what doesn't. How good are they at this point in the president's second term, kind of figuring out sort of what's real and what isn't, and sort of what is an impact on their businesses?
Yeah, well, I think broadly people and clients and, across different, whether it's, middle market, small business, large corporates, uncertainty definitely creates questions for them in terms of, where's the economy going? How are people going to react to it? How do I adjust my business model to sort of new policies? And I think you've definitely seen, that, certainly since April on a number of different issues. But I think, to some degree, I think people appreciate the fact that the administration is trying to deal with some pretty tough issues, but are still trying to digest a lot of what's happening. And I think that's why you see, even in the commercial banking business, in that core middle market client, we still haven't seen, big changes in utilization of their credit facilities, because I think people are still being very cautious and very prudent about making big investments, because they want to see, how the economy develops and how sort of policy develops over a slightly longer time period.
Mike, can you talk a little bit more about some of the expansion of Wells Fargo's business, particularly since the regulatory cap was lifted? There's been a lot of talk about Charlie Scharf, the CEO's deeper push into the investment banking and capital market side of that business. I know we did not see any real material improvement in those results for the most recent quarter, but what should investors expect going forward as to how much of a share of business investment banking and the like will make up of your revenue going forward?
Yeah, well, I think you need to take one step back and think about like the growth strategy that we put in place, and it really started, 4 or 5 years ago, 6 years ago, in some cases, Romaine, and it started with, really focusing the company on what we thought were the most important businesses, products, capabilities, people. That was one part, and that's all the investments we've been making in people and technology and all of the things we've talked about over the years. It also, started with, the efficiency work that we've done. We've saved $15 billion over the last, 5 years. We have reinvested a lot of that back into the business. So the growth story started, years ago. And now when you fast forward there where we've got, additional flexibility now that the asset cap is gone, it's just, making sure that we continue to just go after that opportunity quarter after quarter after quarter. And I think what you've seen is, in the investment banking business, fees are up 12% year on year. We saw a little bit of growth in market share this year on the full year basis. You look across the business, more broadly, credit card applications are up 20%, auto loans 19%, and all the things we've sort of talked about today. And so you're starting to see a lot of those growth drivers start to come into the picture now that we have more flexibility ability just to be more proactive to go after that opportunity, not just in the investment bank or the markets business, but just really broadly across the whole company. And that's what makes us really excited about the coming years, is like that opportunity is right in front of us. It's clear. It's just about executing, every day and every quarter, across the different businesses.
I've only got about 30 seconds left, Mike, but I do want to circle back to where we started with the lending side of the business, net interest income. What's the house view right now for you and your team with regards to interest rates and whether they are going to be a potential tailwind for you and net interest income?
Well, I think, if you look at what's priced into the market today, there's a little over 2 cuts priced in for this year. It's likely at least some of that will happen, it feels like. Certainly the, first couple cuts seem like more certain than maybe from there. And then I think the big question is what happens overall with the 10-year Treasury and other, the rest of the curve and how that moves. And I think our assumptions right now, embedded in our expectations that we set, that it'll be in a pretty tight range and pretty stable from where at the level it is today for the rest of the year.
All right, Mike, always a pleasure to catch up with you, particularly on a busy day like today. Mike Santomassimo, the CFO over at Wells Fargo, on the heels of that bank's earnings, the 4th largest bank in the U.S., just earlier this morning. When we come back, we're going to go from net interest income to fixed income, a broader look at the market action in the bond market with Tony Rodriguez over at Nuveen. This is The Close on Bloomberg.
Morning's economic data failing to spur market momentum, with the S&P set for its first back-to-back losses of 2026. Treasury yields broadly lower, sets up a fairly complicated year in fixed income with tariffs, rate cuts, and inflation risks still in play. Joining us live to discuss is Tony Rodriguez, head of fixed income strategy at Nuveen, which manages roughly $1.4 trillion in assets. Tony, let me just start with a gut check here. How you're feeling when you think about the fixed income space here as we begin January, get through January in earnest here.
Well, good afternoon, David. Good to be with you. So we feel pretty positive about the fixed income space. When you look at the broader capital markets, we're clearly in an environment of some pretty stretched valuations. So whether it's multiples in the equity market, for example. But fixed income, on the other hand, we feel while risk premiums are relatively tight or compressed, yields are actually at pretty attractive levels. And we expect that we'll see either stability in yields, particularly in the kind of intermediate to long end, and also some small declining yields at the front end. So the backdrop is pretty attractive when you think about attractive yields and we think about credit fundamentals. So despite those tight risk premiums, the actual fundamentals, corporate earnings, corporate cash flow, the default rate that we're expecting for this year, all of those are quite supportive, and we expect that economic resilience to kind of justify and support those relatively full valuations.
Tony, we're in this moment where there's this roiling concern about Fed independence, something the Fed chair himself raised over the course of the weekend. How are you thinking about that? How are you thinking about the Fed's path forward here as we look to just the couple of meetings that Jay Powell has left as Fed chair?
Yes, well, we certainly believe that, Fed credibility is a singular factor, impacting the importance and the ability for central banks to function well. And that comes from obviously high quality individuals, but also independent individuals. So clearly that's going to be a key factor. I think that with some of the recent news, there's clearly some risk to that independence. I think the markets have taken a lot of comfort from the fact that some members of the Senate Banking Committee, particularly on the Republican side, have come out in support of that independence. So I think the market right now is in a little bit of a wait and see, but expecting that maybe there's more, there's no fire here, there's some smoke for the moment. But ultimately, our belief is that you'll see a transition to the Fed chair, of course. We think that the overall makeup becomes a bit, certainly more dovish as a result. We think the Fed will be cutting once this year based on the actual macro fundamentals and continue to remove some of the very modest restriction that remains in the funds rate. And that maybe towards the end of the year, you might actually get a second cut that maybe is more kind of a function of that tilt in the makeup of the FOMC to a little bit more dovish stance.
Well, that's what I'm curious about, the second part of that, Tony. And I don't mean to throw a hypothetical at you, but if we do move into a realm where we are starting to see an easing of monetary policy that's more rooted in politics or political beliefs rather than the actual economic data, how does that actually change the strategy for fixed income investors, if at all?
Yeah, so I think the only thing that it really changes is that we expect that you might get that extra cut, which means a modestly steeper curve. But we do think that it actually anchors the long end around current levels. So that additional kind of support for the macroeconomic environment will make it a bit tougher to get inflation back down to target. We think it's heading that way. We think it eventually gets there, but that'll certainly delay it a bit. So I think you have to play it for a bit of a steeper curve, but at the same time, the economic fundamentals, which will remain relatively decent, we're expecting 2% growth this year, that kind of gives you a little bit of comfort in taking on credit risk. Maybe not at the deepest end of the credit risk pool when you think about the CCC area, for example, in high yield or leveraged loans, but certainly dipping below investment grade. We think those companies are going to see solid revenue, solid cash flow, and therefore taking that risk, you are able to earn that additional risk premium.
I am curious about the potential difference in performance that we might see this year with regards to U.S. fixed income assets relative to non-U.S. fixed income assets. And I continue to hear from a lot of folks, primarily emerging market fund managers, as well as European fund managers, who seem to be making the case that 2026 will be a year of outperformance for them. Do you believe that?
Yeah, well, we definitely are overweight to the emerging market area. So we think a lot of the not only macroeconomic fundamentals, but structural elements about a lot of emerging market nations are all moving in a very positive direction. So we do think emerging markets will perform well. In addition to that, we think that the dollar is likely to be stable to weaker over the balance of the year. We're not expecting a large decline in the dollar, but we do think that you'll start to see some decline in the dollar versus both majors and emerging market currencies. So the opportunity to outperform, we think, is kind of stacked in favor of some non-dollar markets and some emerging markets as we move through the year.
Tony, always great insights. Tony Rodriguez, head of fixed income strategy over at Nuveen, as we continue to count you down to the closing bells here on this Wednesday afternoon. When we come back, we're going to talk about banks and that sea of red that we're seeing today in bank stocks. Bank of America, Wells Fargo, Citi, all having one of their worst days going back to April of last year. This despite beating on several key metrics in their earnings report. We're going to break down the complexities of what we just learned this morning when we come back after the break, right here on Bloomberg. A big spike down in crude oil prices. You're looking at WTI crude traded here in New York, a drop of more than $2 a barrel at one point in the extreme. This on the back of comments by President Donald Trump saying that he has been assured that Iran would stop killing protesters and the country won't conduct executions. Remember, these are the words of President Donald Trump himself. We had seen a lot of elevation in commodities prices, particularly in the oil and gas space, largely because of concerns about escalating violence over in Iran and the potential for U.S. intervention in that conflict. We're going to try to get you some more details on that, and we'll get back to that breaking news as soon as we can here. But you see WTI crude bouncing off the lows of the day, but still deep in the red. We want to turn back to the financial space and take a closer look here at the results that we got out of the big bank stocks today. Investors not all that pleased. Wells Fargo having its worst day going back to July. Citigroup having its worst day since April 10th, and Bank of America its worst day since April 4th. This despite beating on several key metrics in their recent earnings reports. Jason Goldberg joins us right now from Barclays. And Jason, kind of makes sense of this. I mean, we can kind of cherry pick any one of these companies that you want to start with. But overall, you're talking about beats on the top and bottom line, but certainly some cautious commentary when it comes to costs and the path ahead. What jumped out at you most about what you heard earlier this morning?
Yeah, listen, I think there's three reasons for the underperformance today. Is one, right, these stocks did have a pretty big run into the spring. You know, the Barclays Money Center composite was up, 40% in 2024 and another 40% in 2025. So there was certainly a high bar for expectations. Second, I think you touched on it. You know, all three banks that reported today did talk to maybe a higher than expected expense outlook for 2026, echoing something we heard from JP Morgan last December. I think, the banks kind of gave good guidance on interest income. No banks really got it to fee income, so you're kind of missing that equation. But the market just took exception to some of this upward expense pressures. Although, we do think part of that is to support better than expected revenue growth. And then just lastly, we do think there's some hangover effect from comments out of President Trump, Friday night, looking to impose the 10% cap on credit card rates as soon as January 20th. And, all the banks that reported to date, are big credit card operators.
Jason, I want to ask you a thematic question here, and that is just about how these banks are doing when it comes to underwriting and advisory and sort of what their outlook is going forward here. We heard Jeremy Barnum on the JP Morgan call yesterday talking about deal timing being an issue here as it looked at the results for this last quarter. If you were to look at what we've gotten so far, what does it say to you about the prospects for underwriting and advisory in the next quarter?
Yes, but in the fourth quarter, I would say, investment banking, generally speaking, particularly underwriting, was a bit soft. I think part of that's a function of, we had the government shutdown 40 plus days. So that certainly impacted results. And you are going to see some deals kind of get pushed out to, the first quarter of this year. But as we think about, 2026 as a whole, pipelines for both M&A activity as well as IPO activity are both quite robust. And we have Goldman Sachs and Morgan Stanley reporting tomorrow morning, and we think both will echo that. So while the fourth quarter may be a bit soft, we do think the outlook for 26 remains bright, particularly for investment banking people.
Jason, can you talk a little bit about specifically to Wells Fargo for just a second? And there's been a lot of reports here about the strategy that Charlie Scharf is taking with this bank, particularly now that some of the regulatory constraints have been lifted. The idea of pushing maybe a little bit deeper into the investment banking side of this business and the capital markets business, which would be a pretty big shift for a company that has traditionally been associated primarily with consumer and business loans.
Yeah, no, listen, they had this asset cap for 7 years. They couldn't grow the balance sheet and they didn't want to constrain the consumer. So they did starve the investment bank a little bit, both from the ability to kind of trade and finance some of corporate customers as well as take deposits. But that asset cap coming off in June, as well as, a fair amount of, senior hires in the investment bank is kind of re-exerting itself. And you're seeing, a nice pickup in kind of announced M&A activity out of them. They've been advisors on some of the biggest deals so far this year, as well as both, loan and deposit growth out of their investment bank as they just re-engage with customers. And so they've had these customers for a long time. They kind of cut back what they're doing with them. And now that they're kind of out of the shackles from the Fed, it's the ability to service them more. And you're actually seeing them pick up market share as a result.
Jason, great to talk to you. Get your perspective on the bank earnings that we've gotten so far. Jason Goldberg, senior analyst following the U.S. large cap bank industry at Barclays. As we're kind of halfway through the bank earnings season here in this quarter. And I know Charlie Scharf saying he's excited to now compete on a level playing field. So we'll see what that translates into here in the quarters ahead. Well, coming up, BlackRock is out with its inaugural advisor survey. What folks are looking for from their advisors. Fascinating findings. We're going to discuss those with the head of U.S. Wealth Advisory, head of retirement at BlackRock. That's coming up here on The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostic.
And I'm David Gura. Looking at markets here lower as we see this rotation underway, Romaine. I think there has been so much focus here on the Magnificent Seven, the promise, the prospect of these big mega cap tech companies doing well. Starting to see signs that the market may be turning on that.
Yeah, and there are a lot of people, I think, looking at this market, particularly coming off of last year and the big outsized gains, really 3 straight years of outsized gains for the broad market. And does that continue? And this gets into the idea of sort of how people who manage other people's money, particularly individual clients, exactly like how you advise them after you're coming off this big run up and into a year, let's face it, that started off with a little bit of chaos.
A little bit of chaos. Yeah. Every day brings more new chaos, but you're right. There's a sense that what we've seen is normal, has been normal. Is that likely to continue? Maybe some signs here that that's not going to be the case.
And when we talk about a lot of the investment advisors out there, BlackRock is out with a new survey. In fact, it's their inaugural Advisor Trends survey, where they actually found that private markets adoption is rising, but allocations remain modest. There are some great data points in there, including the idea of this increase in the number of high net worth individuals out there, presumably a lot of high net worth individuals in need of some type of investment advice. So let's go to somebody who knows a lot about that. Jamie Magyera is head of U.S. Wealth Advisory and head of retirement over at BlackRock, and she joins us today here in Studio 2. Great to have you here.
Great to be here.
I was parsing through this report. One thing that jumped out at me, particularly on the private market side, was the idea that only about 7% of the folks are actually allocated to private markets. In one way it surprised me, in another way it didn't. I know private markets, at least as a portfolio allocation for a lot of people, is still relatively new, but I thought it would be a little bit higher than 7%.
Yeah, so what's interesting is in the study that we've done at BlackRock, you're right, it's the first time we do this. We talk to advisors every single day, but in actually doing this study, we were focusing on high net worth investors and what advisors who want to go after and serve high net worth clients should do. And on the topic of private markets, what came up and what was so interesting is adoption has increased. So the 7% you're referencing is actually the 7% allocation in a portfolio to private markets. Surprisingly, 56% of advisors are using private markets. So that number has increased over the years. And 69% said they were more likely to use them over the next 12 months. So adoption is increasing. It's that allocation that's still really small, 7%.
I am curious, when we talk about that allocation, where do you think it would fall relative to sort of the traditional 60-40 portfolio that some of us from a certain generation were always kind of sold on?
Yeah.
I know that model is sort of over to a certain extent. Where does private assets, what does that allocation look like just kind of across the board in general, potentially?
Yes. So the way that we talk about it and work with advisors around private markets is you have this whole portfolio, right? You have equity, you have fixed income. You should think about public and private exposures. And so that private market exposure could be private equity, it could be private credit. Some advisors are using liquid alternatives or even thinking about things like crypto and digital assets, gold, et cetera. The point is as advisors are thinking about private markets, they have to think about the outcome that it's going to deliver to their portfolio. Is it a diversifier? Is it going to boost their alpha or generate income? Is it going to hedge against something? And so that's the question. It's not what the allocation is, it's the role it's playing in your portfolio and how it complements the rest of your portfolio.
Jamie, as you say, you talk to advisors all the time at BlackRock. Survey of 1,000 of them. You highlight this gap between what advisors are offering and what their clients need. And I wonder if you could talk a bit more about that, sort of where the yawning deficit is and what advisors are doing to kind of compensate or change as a result.
Right. So I'm fascinated by this, and I think it's actually quite exciting. When you think about what high net worth investors, ultra high net worth investors need, what they're asking for after tax alpha, right? They want to understand their portfolio is not just about the investments, it's about what's left after you remove taxes. And so things like direct indexing, things like option overlays, things like tax location, municipal investments, that's what high net worth and ultra high net worth investors want. 92% said they're looking for that from their advisor, yet 17% of advisors, only 17% of advisors said they're actively using that as a part of their portfolio management, which is a massive gap and disconnect, but also I'd say it's a great opportunity for advisors who want to differentiate themselves with these types of clients.
On the subject of differentiation, there's high net worth, there's ultra net worth, and I'm curious how model portfolios factor into that. It seems like from these results, there's been an uptick in the use of them for high net worth, maybe not ultra. How are they sort of parceling out their focus and using model portfolios?
Right. So model portfolios, what are they? They're 60-40 allocations. They've typically been largely ETFs, mutual funds. Advisors who are using model portfolios are using them to scale their business, to free up capacity so that they can spend more time with their clients, which is great. More and more advisors are using models. The differentiator, though, is using those models and actually customizing them for those high net worth clients, for those ultra high net worth clients. What do you customize them with? Direct indexing to manage for taxes. You customize them with private markets to get them more exposure to asset classes they need. You customize them with option overlays to hedge against concentrated stock. It's why, as a firm, BlackRock was so focused, and we've been watching this for some time, so focused on expanding our private markets platform, HPS, GIP, Preqin. It's why we brought Aperio direct indexing into BlackRock, SpiderRock option overlays into BlackRock. It's so we can customize those portfolios or help those advisors customize those portfolios.
How much transparency do clients, for that matter, the advisors have with regards to what's in some of these private instruments, and more importantly, how they stack up? You talk about the idea of sort of trying to match, liquidity, duration, all these sort of various factors here. Is there enough transparency in the private market space to do that effectively?
Yeah, and it depends on the type of private market solution, right? So there are liquid alternatives like mutual funds. There are semi-liquid. There are drawdown solutions. Through our acquisition of Preqin, we are providing more and more transparency now to the private markets. It's similar to what we did and how we built out Aladdin. It's all about helping people understand what they own, the transparency of what they own, the risk in what they own, and that's what we do through portfolio construction and helping advisors understand that.
We haven't talked about AI yet, pat ourselves on the back for that, but I am curious how changing technology is affecting the way that advisors work as you've surveyed them.
Yeah, so there's probably three buckets I would put this in. AI as an investment solution or an investment exposure, and there is so much that we ourselves, BlackRock, are doing in that space and incredible solutions to help advisors give exposures to their clients and their portfolios. There's AI as a productivity bend for advisors. So think about the advisor that is prepping for that client meeting and writing that client playbook and that performance report. Or you could use AI to actually generate that first draft for you, that first plan, and that saves you so much time so that you can do what matters, which is let's have a conversation instead of let me work on the report. And then the third area is AI for personalization. If I think about, as an advisor, I have so much opportunity now to personalize how I'm working with each of you as my clients and delivering solutions to you.
Is there a sense, too, that as we move forward, there's been a lot of talk about this great wealth transfer as the boomers move on, if you will. But there's also been a lot of anecdotal evidence that a lot of those folks aren't necessarily moving on. They're still holding on to their homes. They're still holding on to a lot of assets. Do you think that we'll start to see some of that wealth transfer before these people reach the end of their lives? Or is that really going to end up being the marker?
Yeah, it's
I was trying to ask that question in a very sensitive way.
Very sensitive. You did it very well. So this is the big question, right? Everyone talks about this intergenerational wealth transfer. People are living longer. So people are holding on to their assets for longer. Before we get to the intergenerational wealth transfer, we're getting to the horizontal gender transfer. So you think about the new phase, the new face of wealth, women. Women today control 1/3 of the world's assets. That'll be 50% by 2030. That will be 70% by 2070. Women are outliving their husbands, divorce, and so women are also creating their own wealth. I see us as an industry serving women as the recipients and the capital and wealth creators first, and then it will make its way to the next generation.
Fascinating survey. Jamie, lovely to talk to you. Thank you very much.
Great being here.
That's Jamie Magyera, head of U.S. Wealth Advisory and head of retirement at BlackRock. And coming up here on The Close, sports and real estate magnate Stephen Ross joins Bloomberg America's head Caroline Gage live for a conversation on his expectations for 2026. That's coming up on The Close on Bloomberg. This is The Close. David Gura in for Katie Greifeld with Romaine Bostic as we go to the Oval Office where President Trump is holding a signing ceremony. He has signed some executive orders now, commenting on all manner of things, including what's happening in Iran, what's happening in Greenland, and now Venezuela.
We've never had anywhere near $18 trillion invested in our country, neither has any other country. It's the biggest number by maybe 5 times. 5 times, not 5%, 5 times. Nobody's ever seen numbers like this. We have plants going up. You know, you mentioned I was in Michigan yesterday. I was at the Ford plant where they make the Ford 150. It's one of the original plants. It was from before World War I. It's a giant plant. That plant was probably going to be closed. And 2 years ago, they were doing very poorly. And now they just announced yesterday that they're going to go 24 hours around the clock. 3 shifts, which they rarely do. That's Ford, and Ford's having the best numbers they've ever had. General Motors having the best numbers they've ever had. Stellantis, which hasn't been here, is now investing billions, tens of billions of dollars on building in the country. We're building auto plants all over the country. We're building AI all over the country. We're leading China by a lot, and a lot of it has to do with tariffs. That would be a very disappointing decision. And especially since the people that are fighting me are people that want China to do well. And we're doing great against China. We're doing great against everybody. We're the hottest country anywhere in the world. As I say often, we're right now the hottest country anywhere in the world. And a year and a half ago, we were a dead country. Thank you very much, everybody.
Press. Let's go. Thank you.
And right now we are looking at live pictures from the Oval Office. President Trump, they're at a signing ceremony for an order involving critical minerals. Of course, he was questioned by the press about a wide variety of issues. He pontificated about Iran, saying that he has been told by, in his words, quote, a source on the other side that Iran will stop the killings there. We saw a significant drop down in crude oil prices as a result of those comments. He was also talking about Greenland and the meeting that was taking place a little bit earlier today with the vice president and a congregation from Denmark here about a potential agreement on how to resolve a potential problem with regards to Greenland that the president himself has stirred up. Now, we do want to go back down to Palm Beach, Florida, where our head of Bloomberg America's Caroline Gage is sitting down right now with real estate magnate Stephen Ross. Let's take a listen.
That are here, but that will only grow, I think, as people see the opportunities and where the defense industry is really going.
Any tenants, potential tenants in this space you're talking to right now? Or?
Well, I mean, not that have really, in our buildings, primarily I think they'll be different. They won't be necessarily downtown buildings. I think there'll be some of the headquarters will be there, and some of the startups, maybe, but they need obviously cheaper space and more industrial type space. But I think that you're definitely going to see a lot of that.
What about K through 12? I mean, you've also tried to start tackling that supply-demand problem. Tell us a bit about what's happening with your school in Wellington.
Well, I mean, you can't have companies want to expand in an area without having great education. And since the decision is made by the CEOs, the C-suite, and when you talk to those type of people, they're saying, where are my kids going to go to school? So you got to make sure the decision makers have a place where their children, can go to school. And going to school is really all about getting into great universities. So it has to be a very, competitive, excellent educational school. We were fortunate to find in Wellington, we're starting a K through 12. It was an international school. They have, they were located in Southeast Asia, in Singapore. They have 14 schools. It's called Education in Motion. Here, I forget the name of it, but Windgrove, and it's really very highly rated, and they're going to, be going out to Wellington, and we're really working with them. We've, kind of found them, and they're all on board. And then we have another excellent, highly prestigious K through 12 school that I cannot announce.
Is that closer to here, or is that in West Palm, or what?
It'll be in West Palm.
Okay.
We'll be able to announce that probably in the next 30, 60 days.
Well, you could announce it here if you wanted to. I mean, just saying,
well, let's put it this way. Yeah. I cannot announce it here. I'm under an NDA, so therefore I will not announce it here. But I can just say, when you have two schools and people seeing, the opportunities here, and you're seeing the growth, and you can just feel in the air the growth that's occurring here as the city is really developing. I mean, and it's developing because it has great political leadership, and it wants to grow, and it wants to be, the kind of the model city for the future in this country. And I think anybody living here can feel it. It's a question of how we communicate that to, third parties and to the rest of the country.
Can you talk a bit about the Cleveland Clinic and why that is also something that was so important to you, and how that will change things here?
I mean, having a great hospital, or at least a very good hospital, we don't have that here. I mean, the joke about Palm Beach and living in West Palm Beach, if you get sick, where do you go? The answer was to the airport, So, I mean, we had to really, correct that. So we were able to get Cleveland Clinic. There were a number of other hospitals that wanted to come. I mean, we took the lead, found the site for them, and really kicked off their campaign. They're going to build a new 200-bed plus cancer center, first-class hospital, much like they've done in London and in Abu Dhabi. And Cleveland Clinic has probably rated the first or second best hospital system in the country. So having, that type of brand, Vanderbilt, that type of brand, there's other, and bringing that and showing what they see in the opportunities and the benefits of being here in South Florida, I think is very, very important.
So education, healthcare, I mean, these are both industries whose workforce might have trouble affording parts of Palm Beach. I mean, how do you see tackling that issue?
Well, I started my career in building affordable housing, and we're still today probably one of the largest owners of affordable housing in the country. And you certainly, you have to really tackle that.
And right now we are listening to Stephen Ross. Of course, he is the CEO and chairman of Related Companies, a real estate magnate, of course, also the owner of several sports teams, including the Miami Dolphins. A wide-ranging conversation with our very own Caroline Gage down there in Florida here. We'll bring you any breaking news on that as soon as we get them. You can also type live go on your Bloomberg terminal and continue watching them themselves. But if you do that, you won't actually be watching me and David here as we count you down to the closing bells, David, which are just 10 minutes away. Stocks remain on the back foot as they have been for a good portion of the session.
Therein lies the problem, yes, you pointed out. But let's take a look at markets here as we approach the close. And a couple of things that I've been looking at here as the days unfolded. The first is that bank index, shares of bank companies down about 0.8% here on those bank earnings that we got this morning. Of course, there are more tomorrow, as we've been talking about over the course of the last hour. Looking at the NASDAQ 100 here as well, seeing that fall lower today as we talk about this rotation that seems to be underway here away from these mega cap tech companies, which brings me to the Russell 2000, which I've been paying attention to as well here. Not just today, but for the last 9 days, we've seen it rise here, showing some evidence here that there's some room to run here for these small cap companies. And lastly, just paying attention to that dollar spot index, the Bloomberg Dollar Spot Index. We heard from the president just a few moments ago talking about Venezuela, talking about Greenland, and of course, talking about Iran. And that remains still very much front of mind for a lot of folks here. The president saying he's been told by sources that the shooting, that the violence has stopped in Iran, but still a very open question here, sort of what happens with Iran going forward in the face of those protests. Yeah, keep an eye on crude prices. They're off the lows of the day, but WTI is still down about 2%. Brent crude down about 1.8%. The VIX slightly elevated here on the day. But we do want to go back to what's been happening in the equity market in that rotation, that outperformance by small caps that David was alluding to. Mo Haghbin joins us right now. He's the head of strategic ETFs over at ProShares, and he joins us here in Studio 2. Great to have you, Mo.
Thanks for having me.
Happy New Year. And it's a new year that started off with a lot of people still embracing small and cyclical mid-cap types of names, 9 days of outperformance by the Russell 2000. And I am curious if whether you're seeing, particularly when your own ETFs, a similar sentiment with regards to where investors are pointing their nose.
We are, and as you know, I was here in December. We were talking a little bit about it because it had started. This rotation or broadening out of the market, I think, is probably the thing that most investors have been waiting for. We got to make sure it's not a head fake. We've seen this movie before a few times where small cap and mid cap companies start to get a little bit of outperformance, and then we go right back into the AI theme, right back into the mega cap. And I think this time is a little bit different, to be honest. I think most clients I talk to are really concerned about that concentration risk, and the flows are starting to materialize because last year, we saw that outperformance at the end of the year, but it didn't necessarily coincide with flows into the small cap ETFs, right? So it was a little bit of a interesting dynamic with performance coming back, but not necessarily leading to flows.
On the concentration issue, is the concentration risk in the individual names, or was it on the sector level? And I ask that because some of the buying we're seeing in the Russell or in the S&P 400 mid-caps are still in the tech sector, and some decidedly in the AI sector. They're just not, the NVIDIAs and Microsofts.
Right. I think the cyclical side of things is really where the outperformance will continue or maintain. Part of that is because, remember, in a low growth environment, people chase growth through growth stocks. Yeah. When growth starts to stabilize, and we have that situation right now, it's slowing down, but it's very stable. It's kind of a Goldilocks period. People start to rotate into more cyclical stocks. You've also seen the yield curve renormalize, which is another sign, again, that cyclical stocks may be outperforming for some time.
And to that point, as David was pointing out, the 9 straight days, that's the longest streak going back to 1990. And I went back to figure out what the heck was going on back then, and we were about to enter a recession, which is why everybody was piling into small caps, the counterintuitive nature that, you might have reached the bottom.
Hopefully not remains rule that we're destined for that once again.
Nah, I jinxed it. Sorry.
No, I look at what's happened lately. We've got the leader of Venezuela captured. We have the Danish foreign minister in D.C. talking about the prospect of the U.S. going after Greenland. We've talked about what's been happening in the Middle East. And all the while, I look at the VIX hovering around 16. How do you think through the way that geopolitical risk is weighing on this market, or not, as it seems like it hasn't been?
Yeah, look, first of all, just to step back, there's a pretty big humanitarian crisis going on the ground, right? So let's not lose sight of that. Course. It's a pretty delicate situation, and obviously we're all watching that carefully. As it relates to global markets, though, I think it's always important to take these things and understand what the relevance is to a broader economy, a global economy. Venezuela, as you know, was a really big headline, a really big topic, and people were really concerned about energy. But then when you look at energy supply disruption or the dynamics around that, it was hard to really see a big impact. I think Iran is a little bit different, right? That has the risk of becoming more of a regional conflict or even, expanding from there. So this one, I would say relative to what we saw earlier a few weeks ago is closer for me in terms of political risk that we need to watch carefully. But we always think about it in the grand context of the broader economy. And so far, these things have not expanded to be more global issues.
Curious how you're looking at the inflation data that we've gotten this week. We haven't talked about it yet. CPI yesterday, PPI today. Sort of how you're thinking through the state of inflation in this country and how much credence you're giving that data in light of sort of what's happened over the last few months.
Yeah, great question. So the inflation momentum that we look at inflation momentum as an indicator. It really isn't there, right? So we feel pretty comfortable that inflation is under control and the Fed is a bit more balanced. They have more room to really think about that dual mandate. And unemployment is starting to be a little bit softer. So it's actually kind of an interesting time where a balanced Fed can have a little bit more flexibility. I think the dovish bias will continue, right? We're expecting a few rate cuts this year. If I had to kind of pick one side of that, if I was wrong, it'd probably be more versus less. And that dovish tilt, I think, has a little bit to do with, obviously, the chairman is going to be up this year, the chairmanship, and also the administration and kind of the rhetoric that's coming there. Yeah. It tilts a little bit more dovish in my mind.
But with regards to that last point, and particularly the potential disruption of whatever the heck's going on with the Fed, and we should just remind our viewers, there's a big Supreme Court argument going to take place next week involving the potential to remove Lisa Cook as Fed governor, but really a litmus test for the president's powers. When you see people piling into gold and silver now, more silver now than gold, and some of the other pockets of this market that traditionally are defensive, are you reading that as a defensive play, or is that just kind of tactical opportunity?
I think it's a little bit of both, right? There's also an element of the greenback and the dollar depreciation piece of that, and really thinking about if you're a U.S.-based investor over the last few years, what's happened? Your equity allocations have gone up relative to your policy benchmark just because the U.S. market has outperformed. And as a function of that, because most people get their currency exposure, international exposure through their equity allocations, they're probably overweight dollar as well. So there is an element of trying to get diversification, and I also think the momentum in the sector and the asset class is also leading to some tactical opportunities.
Mo Haghbin, head of strategic ETFs over at ProShares, counting us down to the closing bell. A full breakdown of all of today's market action starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside David Gura, here to take you through to the closing bells with the global simulcast. It starts right now. Carol Massar and Tim Stenovic in the radio room. Katie Greifeld on assignment today. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube. Carol Massar, you have a grin on your face. I haven't seen you in days. I don't know where you've been. But we talk about a market that's on the back foot today for a second straight day. And I think really trying to get their handle around economic conditions, corporate earnings, and of course, whatever the heck is going on in Washington these days.
Yeah, right. Taking your cues from so many different places makes it really hard to figure out strategy. Having said that, even though the S&P 500 is down for a second day, you dig inside the index and you've got more names, more than 300, actually gaining ground on this Wednesday. So it's good to dig a little bit deeper to get a little bit more of what's going on in terms of investors thinking.
It does look like the S&P 500 will close down for a second consecutive day. And if that does indeed happen in the next, 40 seconds, this will be the first.
Good call, Tim.
Sorry, excuse me. Go ahead. What did you say?
Nothing. Keep going.
Okay, all right.
Technical difficulties.
Yeah.
Boy, do I.
David's like, what did I get
David
myself?
has no idea.
To answer the question, David, this is what you got yourself into.
This is what happens on weekdays.
This is what happens.
For those who know, David Gura anchors our weekend line here.
Okay,
he has no idea what goes on Monday through Friday.
I just want to point out that
chaos.
Year to date, we're still up more than 1% on the S&P, and we're only 14 days into this year.
Absolutely. Though we are getting a meaningful pullback here today. You add that to some of the softness that we saw yesterday, and it is raising a lot of questions about exactly where investor sentiment is. We're going to walk you through these numbers because it is a somewhat complex day on Wall Street. You take a look at the Dow Jones Industrial Average. We're just going to kind of call it unchanged on the day. It is down in the red, down about 40 points, but less than 0.1% on the day. We saw a more meaningful drop lower on the S&P 500, which shed more than 30 points, or about 0.5% on the day. The NASDAQ Composite down more than 200 points or 1% on the day, a similar percentage drop for the NASDAQ 100. But you go into the cyclical space. Dow Transports unchanged on the day. S&P equal weight up 0.4%. S&P 400 midcaps up 0.1%, and the Russell 2000 adding about 18 points or 0.7%, a ninth straight day of outperformance relative to the S&P 500, the longest streak of outperformance, Carol Massar, since 1990.
Wow.
I wasn't alive then, but I'm sure it was exciting.
1990?
Yeah.
What were you, like 30 already? 40? I don't know, something
ouch.
like that.
Yeah.
Hey, let's go inside. I love how you
Benjamin
went.
Button.
I love how you went deeper, because I do think you can't just look at the major market averages, because there's a lot more going on. Having said that, dig inside the S&P 500, David. You've got 318 names actually gaining ground on this Wednesday, 184 lower, one unchanged.
Let's pull up the IMAP function on the IMAP function here on the terminal and look at that on a sector by sector basis. And the story here today has been one of a rotation. Do we have one that has begun in earnest and has some staying power? And you just look at those sectors, sort of what the decliners are. Information technology, one of the biggest decliners. Energy, consumer staples, real estate. So I think adding fuel to this fire, this sense that maybe there is this rotation underway. Of course, there is this. You got to see if it sticks. That's the problem. We'll see what happens here tomorrow.
Yeah, exactly. All right, and certainly a lot coming out, investors. All right, let's get to some of the individual gainers, if I may, in the green. See, look at that outperformance today. You got Dow, the number 2 gainer in the S&P 500. Lyondell, ticker LYB. That's the number 1. I think Dow is the number 2 gainer in the S&P 500. This is coming after Citi analyst Patrick Cunningham removed the 90-day downside catalyst watch on the stocks as polyethylene prices improve and ethane prices fall, helping the firm's integrated margins. You also had U.S. chemical stocks rising as higher oil prices were giving gas-based producers an advantage, and analysts see upside for U.S. chemicals and fertilizer firms. So you have that play, and that's maybe some of the story. So Dow up about 6.5%, Lyondell up about 6.8%. Some outperformance. And then flip it on over to Mosaic, ticker MOS. It too was a top gainer in the S&P 500. Morgan Stanley analyst Nigel Daly maintains an equal weight on the stock, raises the price target from 33 to 35, stock closing at just under $28 a share. So that's certainly at play. And then I just want to mention Strategy, ticker MSTR, top in the NASDAQ 100. Bazinga Newswire noting that one of the strategy directors, Carl Ricketson, bought about 5,000 shares of the company for the first time in 3.5 years. And that's after the stock crashed nearly 70% from its November peak. So that purchase by this director marking a reversal from his previous pattern of selling shares, having filed 19 separate SEC forms showing only stock sales over the past 3.5 years. So insider buying, right? Always often seen as a positive sign. So we'll see. Time will tell. Because
I just want to add one honorable mention in there, Carol, and that's with Critical Metals, which was up more than 30% here on the day. A small cap company, but one that could potentially benefit from whatever the heck is going on between the U.S. and Greenland.
All right, let's get to some of the decliners now. I want to start with the banks. Bank of America, Wells Fargo, and Citigroup all falling. Bank of America down close to 4%. Wells Fargo down 4.6%. Citigroup down 3.3%. We're going to talk about this with Kat Doherty in just a second, but all of these banks reported earlier today. We heard different things from all of them. Citi's Jane Fraser saying that telling employees the bar is raised. She signaled further job cuts to come. Bank of America shares declined amid concerns about expenses, even though equity traders posted their best fourth quarter ever. And Wells Fargo missed analyst profit estimates as severance costs drove up expenses. Also taking a look at tariff-related stocks. Those today
That's just
slid.
one decliner?
That's just one. This is all for you, Carol.
Jeez.
Finley said this is okay, our producer.
Actually, Finley said.
I checked with her.
Actually, Finley said Tim next with his 5 million decliners.
Okay, that's how we're. You know, when a lot of stocks are down, I got to use it to my advantage.
All right.
Mattel, Hasbro, Lululemon all took a hit today. These after the Supreme Court did not issue an opinion on the legality of those IEEPA tariffs. We'll see when we hear from the Supreme Court next if we do get some clarity there. We're going to be speaking to Rick Woldenberg over at Learning Resources. He's actually one of the CEOs who's bringing this lawsuit to the Supreme Court. He's going to join us in our 4 o'clock hour. And finally, look at hotels, resorts, and cruise lines today taking a hit. This is the S&P 1500 Hotels, Resorts, and Cruise Lines Index down 1.41%. We can also say home builders also fell today. Yeah. This after the U.S. State Department gears up to suspend processing visas for people from dozens of countries, including Brazil and Nigeria.
And just to add honorable mention to that, really the big
I
drop
did
that we
every
saw
stock that was lower today, Romaine. There are no honorable
You did
mentions.
not, actually. You actually missed the software stocks. We saw a big downdraft in a lot of those names like AppLove and Intuit, DocuSign, and quite a few others, particularly the application software stocks. Keep an eye on that space here as investors do continue that rotation. And keep an eye on what's been going on in the bond market. We did see a more meaningful move in Treasury yields on the back of that economic data, and it was to the downside. A 4 basis point drop on the long end of the curve. Your 30-year yield down 4 basis points. Similar move for your 10-year yield. Your 2-year yield down about 2 basis points. And we should point out the move on the 10-year and the 30-year down, the most meaningful drop that we've seen on a one-day basis in at least about 2 months.
All right, let's get to some stories that definitely jumped up on our radar. And this one has to do with the former New York City Mayor Eric Adams promoting a new crypto asset. It's called NYC Token. Portion of the proceeds going to fight anti-Semitism and educate children about the blockchain, Tim.
People are not happy, though, because the value of the token surged as high as 58 cents. Then it crashed under 10 cents. Crypto market observers drawing parallels to a, quote, rug pull. This was kind of a thing that happened with the meme coins in the past. You'll remember Eric Adams wanted to be the first crypto mayor.
Yes.
Did accept a couple of his first paychecks.
Yeah.
In
well, he was the first on a lot of things as mayor, not always necessarily good things. I do just want to point out, because I was looking at this. At one point, we talked about a market cap for this particular coin, which is $NYC, $600 million. It came in at $100 million. As of right now, at least based on the pricing on CoinMarketCap, $10 million. Now, you're the crypto expert, Tim Senevic. I believe you host a show called Crypto
Tuesdays at noon.
Something, right? Yeah. Is it Crypto IRL?
No, this is Bloomberg Crypto.
Oh, sorry. Is that too soon?
Sorry?
All right, we're going to move on here because another big story that we've been keeping an eye on, actually, in all seriousness, though, I mean, in addition to the rug pulls potentially going on in the crypto space, there's been a lot of concern about the health of the consumer and really the health of retail. We just learned that Saks, the company overseeing Saks Fifth Avenue, Bergdorf Goodman, and Neiman Marcus, filing for bankruptcy. And this is raising a lot of questions here, A, about whether somebody will actually buy them out of bankruptcy, but also just really about whether, like, these types of companies, particularly those with the big brick and mortar presence, can still survive.
I lean on the old cliche from Ernest Hemingway, how do you go bankrupt gradually and then suddenly? And that's very much the story here, Romaine. Looking at how this company was doing, there was a lot of positive talk, a lot of infusion of cash earlier this year. That has changed with this Chapter 11 filing for Saks. They are optimistic, however, that later this year they will get out of.
Didn't they just buy Neiman Marcus a year ago?
Yes, they had the big roll up a year ago. They brought in Bergdorf, Neiman. They were supposed to be kind of like, Voltron together. They were going to be stronger than apart.
They issued a lot of
debt, here we are a year later.
To do it.
And I think they're counting on Neiman's former CEO to get them through this. So it's all in the family.
Yeah.
All I know is...
All right, we got to let you guys go because Tim's having trouble hearing. There's something going on with Carol's hair today that's throwing me off. I don't know what's happening over there.
It's great to see Carol.
Yeah.
David, are you going to come back tomorrow, do you think?
If asked, I'll serve. I believe that
Hey, David,
Katie Greifel will be back.
You can come back.
Thank you very much.
That other guy, not so much.
We've just met, he and I.
All right, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We do call it the closing bell without Romaine Bostick. No, with Romaine Bostick. He and David, of course, continuing there on the close on Bloomberg TV. Tim and I continuing right here on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow.
Stick with us. Our coverage continues here on The Close with a closer look at the state of the consumer, the state of the economy, and the state of small business. That's coming up next right here on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Romaine Bostick.
And I'm David Gura, in for Katie Greifel.
And anyone who was looking for a boost in equities on the back of economic data or corporate earnings, well, they're going to have to wait a little bit longer for that boost. The downdraft today for the broader market with the S&P 500 pulling back by just about 0.5%. You did see, though, some meaningful outperformance in the cyclical space with the Russell 2000 outperforming the S&P for a 9th straight session. Keep an eye on apparel stocks. They took a big downdraft down here on the day, having their worst day going back to mid-September, and this on the idea that we did not get a ruling from the Supreme Court on the legality of Trump's tariffs. The uncertainty hanging over a lot of apparel makers like Nike and Lululemon, that still remains in place. The VIX making its most meaningful move higher that we've seen since November. It may not seem like much, but that is significant. And silver, David, continues to roll in another record high for the metal.
This was the day when we got more bank earnings, heard from Citi, Bank of America, Wells Fargo as well. Each of these stories is different, as our colleague Tim Stenovec said just a moment ago. All of them beat on some factors and not on others. Looking here at all of them, though, they're lower today, dramatically lower. And I think it points to the story of a lot of reinvention on the part of some of these banks, particularly with Wells Fargo, which we see down 4.6% today. This is one that got underneath an asset cap for many years, emerged from that recently. We heard from Charlie Scharf, the CEO of that company, saying he feels liberated, ready to compete now that asset cap has been removed, Romain.
Yeah, and we pay close attention to the banks because it does provide, well, a closer read on the economy. And that is our top story of this hour, the economic tea leaves and really the difficulty in reading what's actually splayed out there on the table. Take a look at the 10-year Treasury yield. Today, seeing the biggest one-day drop since late November after being stuck in a narrow corridor as traders really struggled to get a clear read on the economy. Last week's employment report, yesterday's CPI data, that did little to clear the fog. But given the central role of consumer spending on GDP, that retail sales data this morning may matter more. Monthly sales were relatively strong, but it was wealthier Americans bolstering those numbers. And since retail sales aren't adjusted for inflation, the gains there also are a reflection of higher price tags at the store rather than increased demand. The picture for small businesses, remember, they account for at least 40% of economic activity and half of the labor market. That's also muddled. The National Federation of Independent Business just yesterday issued a report that points, well, to improving sentiment among owners with regards to current conditions, but that's being offset by softer expectations for sales growth and hiring up ahead. Let's bring Holly Wade into this conversation. She's the executive director of the NFIB's Research Center to talk a little bit more about those numbers. And Holly, let's first start with the here and now. Those numbers did seem to be pretty positive. Seem like most business owners right now do feel relatively good about where they stand.
Yes, our December report was largely positive. Small business owners are feeling fairly optimistic about moving into the new year, into 2026. And their expectations of business conditions improved quite a bit over the last month. But as you mentioned, sales expectations did fall. So we'll see how this evolves in the next number of months. But largely a solid footing for most small business owners in operating their business.
What's the general outlook that you're getting from these surveys with regards to how they see inflation and, more importantly, the impact of inflation on their business?
Well, as you saw in our report, our uncertainty index also fell. So small business owners are feeling a bit more certain, comfortable in operating their business. Consumer spending has supported a lot of small business owners moving through 2025, the last half, while the uncertainty element that was so prevalent in the first half has moderated quite a bit as a lot of those policy shocks at the beginning of the year, navigating those challenges, have moderated. So inflation, the labor market, they are more comfortable in making decisions. And those two challenges that are still quite significant for some small business owners, both have moderated quite a bit for the majority of them in operating their business.
Holly, you bring up the labor market. We're in this now famous low hire, low fire labor market. I imagine a lot of these businesses wrestling with the prospect of, do they bring on additional staff or not, given the uncertainty that you've been talking about. What can we glean from the data, from their responses about how they're feeling about the labor market, their kind of emphasis on quality in the labor market in particular?
Yes, so we still see about 1 in 5 small business owners say labor quality is their top problem in operating their business. So while some of them are hesitating and maybe putting a pause on filling some of those open positions, fewer are saying that they're anticipating increasing their workforce in the next quarter. It's still a challenge for many, especially in some of those industries, for instance, construction, a few in manufacturing, transportation. They're really having a hard time finding applicants and those that have the right skilled match for what they're looking for. But it does appear that the labor market for the majority of small business owners has moderated to about a kind of a new cruising altitude, tighter than it was was before, but certainly not as challenging as it has been over the last number of years.
And hopefully not as bumpy. I'm curious how you look at these data kind of in the complement of other softer or hard data that we've gotten on the economy. When you look at kind of the state of the U.S. economy, what does this tell you that's unique about the state of it today?
Well, it was pretty much a quiet report. We didn't see a whole lot of volatility within the numbers of ours. And, when looking at, say, CPI data, we have about 12% now saying that inflation's their biggest problem. And that's a dramatic decline from where it was a couple of years ago. And so fewer small business owners are planning to increase prices. Fewer have actually increased prices over the last quarter. And, it's reflected in what we see more nationally with CPI data, and that while there are pockets of stress on inflation and challenges in pricing in that area, it's moderated quite a bit. And that's been a huge help for small business owners in operating their business and feeling comfortable in competing in their industry among, other small business owners, but also their larger counterparts. So that their ability to make decisions and feeling more comfortable in understanding the playing field has been really helpful for most of them, which has made, as I said, our latest report, pretty quiet. They're optimistic. They seem to be on solid footing. And a lot of those challenges that they had, say, at the beginning of the year have moderated quite a bit.
I am curious, Holly, I just want to ask you just about the general idea of data collection practices against the backdrop of kind of what we saw with the government shutdown and some of the disruption that we saw in the official government data. I know you're outside the purview of that, but it gets to this idea, too, of data collection practices, whether they have kept up with the times and whether we are getting an accurate reading of what these people, whether it's survey data like yours, what they really think, or whether it's hard economic data, whether that's a true reflection of that economic condition.
Sure. So yes, everybody in the survey business has been dealing with a lot of these challenges in trying to connect with those who they're interested in learning more about either their consumer behavior or small business operations. And so making those connections have been increasingly difficult. We still do it old school. We mail surveys to their business, have them fill it out and send it back. But it's increasingly a challenge in making sure. So I think the result in the survey space is probably a little bit more noise, a little bit more volatility that we wouldn't have likely seen 10, 20 years ago. So we're just trying to figure out different modes of which to connect to whoever we're trying to survey. And, as with our survey, with other people's survey in national data collection, it's an ever evolving environment in which to try and get that data so we can get a clear picture of what's happening on the ground.
Holly, thank you very much. That's Holly Wade, Executive Director of the NFIB Research Center, with those new data. And Romain, I'm looking here. We were kind of waiting on tenterhooks today, wondering if the Supreme Court was going to rule on this tariffs case. And an interesting finding from that optimism survey data just has to do with small business owners and how they feel about and are being affected by these tariffs. And 64% of those small businesses reported that the supply chain issues are an issue for those businesses. Yeah, I mean, we always sort of throw out this idea that markets hate uncertainty. And there's certain relevancy to that, not just for markets, but for business owners as well. Any clarity you can get, whether that clarity is good or bad, as long as you have that clarity, it at least gives you the ability to navigate around it. Absolutely. Well, coming up here, President Trump's credit card cap weighing on Wall Street as one firm takes steps to meet the president's demands. That story's coming up next. This is The Close on Bloomberg. This is The Close. David Gura in for Katie Greifeld with Romain Bostic. Fintech firm Build unveiling 3 new credit cards with interest rates capped at 10%, just days after President Donald Trump threatened lenders that failed to do so. Here to discuss is Bloomberg's consumer finance reporter, Paige Smith. Paige, I look at the details here. Yes, it's 10%, but in pretty short order, maybe a year later, the APR could shoot up to 30-something%. Mark the moment. What is Build trying to do here?
Well, I think that it certainly has people talking, us included. I will say that. I think that it is, as you noted, that it's very important to make clear that this is a temporary introductory interest rate. A lot of credit cards have interest rates that are, some have interest rates that are low as low as 0% for as long as 18 months. It's not uncommon for credit card firms to roll out these sort of deals to entice new customers. And as you noted, Bilt unveiled 3 new credit cards today, 2 of which have annual fees, one is free, and they're looking for customers. So it makes sense.
Do you have any sense, though, of how this would affect their business? I mean, at 10%, I would assume, I mean, he talked about going up to 30%, but even just look at average credit card rates in this country are like 20%. So you're talking about at least half. And I am curious if that sort of upends, even if it's just for a year, upends to a certain extent some of their profitability.
Certainly. So it's important to understand kind of the broader ecosystem that Bilt has kind of created over time. And it's a company that was founded by an individual named Ankur Jain. And essentially what they've done is the credit card is a great product. It's very beloved. A lot of folks have signed up for it. They've publicly said that there are now more than 1 million cardholders. But what they've done is created this sort of merchant and landlord ecosystem that has actually evolved. So the credit card was their wedge product, but only 15% of their customers now, I believe that's the figure approximately around there, that's only 15% of their overall customers are card holders. It's much more than just a credit card company.
I want to ask you about the potential knock-on effect of what the president has proposed here. And Jane Fraser of Citi, in her call with analysts, said, look, studies have shown this is going to have a really deleterious effect on people's ability to get credit going forward here. What do we know practically about sort of what it would mean if a cap like this were to go into effect, if Congress were to pass it and put it into place?
Certainly. So what we know currently is what analysts have been saying, because we, first of all, have not actually seen a formal proposal of any kind from the White House. It's still relatively early days, even though President Trump made his social media post very late on Friday evening. But
Noted.
Noted. But we do not have exact details of what the administration would really like banks or credit card issuers to exactly do beyond this sort of proposal of capping at 10%. But we certainly have heard in bank earnings yesterday and today that bank CEOs do not love this idea, not
much
shockingly.
eagerness. Yeah.
We will sort of watch closely and see how they continue to react. If we do get substantive details, we may not. Who knows?
All right, Paige Smith, reporter here at Bloomberg. A great story on the Bloomberg terminal involving Bilt and unveiling the new credit card that caps the rate at 10%. A potential salvo there here to a proposal by President Donald Trump. When we come back, we're going to go from credit card caps to, well, private credit catalysts. A conversation with Kristin Olson, Goldman Sachs' global head of alternatives for wealth. That's coming up next on Bloomberg. Alternative assets, at least as a share of overall global investments, they're growing, helped in part by soaring interest in private markets. Our next guest tracks alternatives for one of the world's largest and most influential banks and expects a complex yet dynamic environment for private markets this year. Kristin Olson joins us here in Studio 2. She's global head of alternatives for wealth, that very significant bank called Goldman Sachs. Great to have you here.
Thanks for having me, Raymond.
All jokes aside, I mean, we talk about the interest in private markets. We know this is an industry that has grown exponentially over the last few years. But this is like the first time in the last year or so where I think, other than the ultra high net worth individuals, where a much broader class of people are getting access, or at least they want access to this area. Where does that growth come from within that space?
Sure. So obviously we're seeing a lot of interest by individuals in getting access to alternatives. Conversely, we're seeing a lot of interest by alternative asset managers in getting access to and tapping into that vast amount of individual wealth. And so what you've seen over not just the last 1 year, but I'd say the last 5 years is incredible innovation in terms of providing broader access to individuals. New structures, new wrappers that are allowing individual clients who usually weren't able to get that access to tap into private equity, private credit, and real assets.
Well, let's talk about the private equity and private credit side, because to a certain extent, there has been better access to real assets to varying degrees. But private equity and private credit, to a certain extent, were closed off for a large number of people. How are they approaching this, not only from the potential returns that they can get, but also dealing with the reality of liquidity issues?
Sure. So I think private equity is a place where we've been really focused and very constructive. It's the largest allocation for us within the alternatives allocation. And I think if you look historically at the data over decades, private equity has been able to generate 600 plus basis points of outperformance to global equity markets. Now, if you measure that on a shorter period of time, that obviously narrows because it's been hard to beat a market that's been, up and to the right for the last 5 years. But that brings back to kind of really focused on manager selection, right? Because in alternatives, different from the public markets, you really don't want to own the index. You want to own first and top quartile managers. And if you do that, you're going to be rewarded. So I think what we think about it is, what is that extra return, that alpha that you can get relative to the liquid alternative of public equities or public fixed income? And I think by and large, that's been persistent and clients have been pleased with the returns that they've seen.
Just a question about the zeitgeist when it comes to private credit. So we emerged from last year with this kind of moment of market entomology, Jamie Dimon talking about cockroaches, and I think spooked a lot of people. How has that kind of rippled out? What effect is that having on clients' appetites for private credit going into 2026?
Yeah, so I think we're going to see stability and we're going to see resilience in appetite for private credit. Look, when the move into this direct lending space by individuals started and by the broader market, returns and yields were double digit, right? They've come down, right? But even at 8-9%, that's still going to outperform what you're going to get in the public markets. I think the impact that you're seeing, cockroaches and some of these idiosyncratic things that happened at the end of the last year, do create some sentiment shift. So I think you do see flows slowing a bit into private credit, and you may see a slight pickup in redemption activity. But what's interesting is it's based more on the headlines than it is on what we're actually seeing under the hood, which has actually been relatively low defaults. We haven't seen an increase in defaults. And again, back to manager selection, I think that if you pick the right managers that can pick the right credits, you're going to be rewarded in the long run. And as we go into 2026, if we see a pickup in deal activity, that's going to create new opportunities for direct lending.
Is the regulatory landscape a risk here as you look at sort of what the first year of the president's second term has been like when it comes to regulation, the way that he's approached it and the way that regulators have approached it? Is it something that clients, investors should be worried about when it comes to these spaces that aren't as heavily regulated as, say, the banks are and other financial institutions?
Well, look, I think some of the easing of regulation is actually what's helping to open the aperture to a broader universe of investors. So it's actually allowing them to get a foot in the door. I think what's important, we talk about this a lot when you go to individual investors going into less liquid asset classes, which have a lot of different features that they're not used to, is how does the industry educate the individual investor about risks that they've never thought about, whether it's illiquidity, different fee structures, right? All the different things that they don't have to think about in their traditional 60-40 portfolios.
I mean, some of the concern that's been expressed, it seems to be, it's less on, of course, some of the more customized stuff and the SMA type stuff, but the idea that you're going to have a lot of people with 401ks looking at their offerings and then just making, potentially an uninformed decision about allocating there. And I am curious as to, just in terms of how you pitch products at Goldman Sachs to your clients or through advisors, how do you sort of address that issue of education, that there are people that aren't going to get that customization? They're going to have maybe not necessarily the index, but certainly something that's a little bit more one size fits all.
Yeah, and I think that's okay to have. You want diversification, right? You might want a solution that covers a number of different ways that you implement. But I think the important thing about education is even at a high level, which is, and this is one of the things on the new structures we talk about for individual investors, is while they have features that seem like quarterly liquidity, just that basic education that liquidity, though, might not be there if you read the fine print when you actually need it. And so it's a really high level of education, or reminding them that this isn't a liquid asset class, and your mindset on this in terms of how long you should be in this should be very long. And actually, one of the beauties of retirement and 401k is that's the place where you have the longest duration. So in some ways, alternatives make a lot of sense for investors that are young and thinking about their retirement decades away.
Kristin, great to talk to you. Great to meet you.
Thanks for having me.
Kristin Olson, Global Head of Alternatives for Wealth at Goldman Sachs, joining us here on set in New York.
All right, we talk about the broader markets here. A second straight day of losses for the broader market. The S&P 500 down about 0.5%, a much more pronounced drop that we saw today in the tech space, that is, with the NASDAQ down about 1% here on the day. You see the Magnificent Seven pulling back by about 1.5%. But keep an eye on the weakness that we saw today in apparel stocks, in bank stocks, and in a lot of the other sectors here with a little bit more direct economic exposure that could end up being a big story, particularly as we head into next week as earnings season really starts to ramp up with the non-bank companies. This is The Close on Bloomberg.
trade, restrictions of migration, fiscal deficit, trying to affect the independence of the Fed, rule of law. The maximum from an empirical point of view could be a negative 50 basis points downside to potential growth. So you have an upside of 200 from technology, you have a downside of 50, is a ratio of 4-1, so tech trumps tariff. So the stuff that is technology is first order, everything else, including geopolitics, is second order.
Economist Nouriel Roubini emphasizing tech's influence over the global economy, magnified by some of the leaps forward that we've seen in artificial intelligence. Our next guest, well, he's been at the forefront of that. He was one of OpenAI's first 100 employees. He's now out with a new book called The Next Renaissance, AI and the Expansion of Human Potential. Pleased to say Zach Kass joins us right now, the former head of go-to-market over at OpenAI, and now a global AI advisor whose clients include Coca-Cola, Morgan Stanley, and Amgen, among others. Zach, great to have you here on the program. And we kind of led in with that comment from Nouriel Roubini, Dr. Doom, if you will, who's actually rather optimistic about the impact of AI on our society. And I do want to start there because for the last 3 years, really, there's been this outsized attention on AI. And a lot of that has been relatively binary in the outcomes that people look. Either it's going to save us all or it's going to kill us all. Talk a little bit about what your book actually lays out with regards to how AI is integrated into our society and whether there will be net benefit.
Well, first of all, it's great to be here. Thanks for having me. And it's really fun to see that Nouriel clip because he and I met in July last year when I think he said that first, when he said technology trumps tariffs at an event in Lake Como. And he and I joked. I said, Dr. Doom and I finally agree on the outlook. And he said, pretty clearly, this is an exponential technology and the economy is going to rip. And so far it has in some ways, although obviously not others. This actually also is a nice dovetail into the sort of point on society, which is things tend to go much better over a period of time than we expect. And sometimes it just takes longer. And part of what the book tries to paint is a perspective, which is to say that we are now living in an age of sort of high expectations, ever greater all the time. And the impressive thing about inflation right now is that we lived for so long in a deflationary environment that when things got slightly more expensive, people got really aggrieved. And Nouriel points out, as I'll agree, which is that technology is the principal driver of deflation unless government intervention. And in these deregulated markets, we're seeing incredible success for the average person. And the point of the book is to remind people that over time, the human experience gets better, and this is no exception.
I am curious. I mean, just a couple of days ago, Jensen Huang was kind of raked over the coals because of a comment he made about people being too negative on AI. And in his view, that was kind of holding back some of the progress there. One of the pillars that you talk about in your book is this idea of leading with optimism. But I am curious as to how you square that circle with the idea that while there is certainly an optimistic outlook for how AI improves our lives, there's a lot of anxiety as to whether AI, to a certain extent, replaces certain aspects of our lives, including our jobs.
First of all, I completely appreciate anyone's cynicism right now and sympathize with people who look at this moment in time and are terrified. In fairness, human happiness has not correlated with standard of living over the last 30 years. I think it's safe to say at this point that the addiction to the device, the addiction to the screen, has driven an enormous amount of cynicism and despair, especially in the younger population. And I argue that this is the tragedy of unmetered information. We told everyone everything, but we didn't actually give people the tools to actually process it effectively. When you and I graduated high school, we knew very little and we were fine with that. And we just didn't know how broken the world was until we were much older. That's different now. And my argument is actually not that people shouldn't talk about the problems. It's that we should actually spend more time on the solutions. Where I think Jensen may get in trouble when he talks about people needing to be more optimistic is that I don't think the industry has done an effective job telling its story. Part of mainly why I wrote this book was to give a nuanced, non-obvious take on behalf of an industry that has told everyone everything's going to be great forever And technology lost that trust because of social media and the device. We got to win back trust to convince people this technology is actually going to make the life better for the average person. And that starts by actually seeing the effects of this technology in things like cost of goods and service and novel scientific discoveries.
Zach, there's a cynicism about the technology itself. I think there's also cynicism about the business model as well. We saw OpenAI announcing another new partnership today. There is kind of an ellipticalness or a circularity to the way that these businesses have been operating over the last few months. And I think a lot of people have been wondering, as all of this money goes into building the infrastructure that buffets AI or the promise of AI, where does all of that lead? Don't need you to call a bubble or not call a bubble here, but help me understand sort of how you're thinking about that level of cynicism, that, that we have been promised something, we don't know the timeline for which that will come to fruition, and there is a lot of skepticism just about the pathway to it.
Yeah. Well, I'm not going to tell anyone that any given AI investment is a good one. I think that, let's be clear, it's a random walk. And picking a stock is pretty tough. I also will say that there are going to be some weird downside events that impact companies more than others. Policy, major scientific breakthroughs that change paradigms and architectures that update. But what I would tell most people is being in the arena, either betting on AI broadly or building an AI company, is going to be net valuable. And the reason for that may not show up for a little bit. My reminder to most people is the infrastructure that we're building today, be it data centers or certainly power, is going to have very impressive knock-on consequences for a long time. And this is infrastructure we wanted anyways. And so the fact that we can now fund it is, I think, without state subsidies, is actually a really good thing. Moreover, the best news in AI is not actually the AI stocks, in my opinion. It's all of the other businesses that are going to have incredible windfall because they can now do more impressive things. And this is traditional industry. This is probably going to be American economy that we start to see buoyed by this, and certainly things like life sciences, novel sciences, material sciences.
Are we there yet, Zach? I mean, a couple of weeks ago, we got some productivity numbers here in the U.S. that seem to suggest there's been a material improvement in productivity that some people are linking back to AI and technology. Of course, we had the Nouriel Roubini comments on Bloomberg the other day. But also, I'm curious, in your capacity in advising these companies now, are they approaching this from the perspective of their own internal productivity or more from creating products and services that they can sell to other people?
Both. There's a broader pursuit by most companies right now to build AI systems that allow them to find incremental gains. And then there are specific companies, and some are public, some are not, that are trying to create exponential or sort of superlinear outcomes with this technology. What I would say to you and to any of the listeners actually trying to make sense of the market, I think that the big problem that we're seeing right now is that Fortune 500s are sprinting ahead and startups are sprinting ahead. Both of these companies have a lot of means or a lot of agility, and in some cases both. It's the mid-market where I think we are going to start to see some weird red flags, and especially in a country that is sort of powered by a lot of companies between 10,000 and 500 employees. What I think we need to start paying attention to is how well AI actually helps the entire economy rise, because most businesses in the United States with 1,000 employees do not have a single ML engineer and are not actually equipped to adjust to this technology as rapidly as everyone else.
All right, Zach, always appreciate it here. We have to leave it there. Zach Kass, the former head of go-to-market over at OpenAI, now a global advisor in that space. And, well, he's got a new book out. David Gura, do you want to try to pronounce it?
Is it Renaissance? The AI is italicized in a way that I find amusing. So we'll ask him after the break. Still ahead, a conversation with Carla Sands, former U.S. ambassador to Denmark. That's coming up here on The Close on Bloomberg. Well, the fight for Greenland continues. Danish foreign minister says a fundamental disagreement remains after a meeting of top diplomats in Washington, D.C. today. Members of the meeting did, however, agree to form a working group set to gather within weeks to plot the way forward. Joining us now is Carla Sands, former U.S. ambassador to Denmark during the first Trump administration. Ambassador, great to have you with us. And I wonder if you could take the perspective that you got on the ground in Copenhagen and give us a sense of how vital an issue this is for folks in Denmark and how you see them as perceiving what's happening here with the conversation about Greenland and what's happening in Washington today.
Sure, and thank you for asking. I have to say, we also want to think about the Greenlanders, right? Not just Copenhagen, but Nuuk, Greenland, because I spent a lot of time there as well. And Greenlanders are great friends of the United States. They're actually related to our native population in Alaska. And so there's a lot of similarities in their cultures. They want prosperity and they want security just like every other country. And what I learned on the ground is that Denmark doesn't have the capacity. They just don't have the funds or the people to be able to develop or secure Greenland. It's like when you own an asset like a house or a building and you can't really afford to take care of it and improve it. And so you just have to sell it. That's kind of the situation with Denmark and Greenland. Let's consider it's the world's largest island. It's 1/3 the size of the continental US, just off the northeast coast of the U.S. And here's Denmark, a country of less than 6 million people with an economy about the size of the state of Colorado.
You have a particular insight into the way the president looks at this issue, and there is this comprehensive defense agreement that's in place. The U.S. could put more military bases there, increase security there. Yet the president said in that interview with the New York Times last week there's an element of psychology of ownership that's important to him. Help us understand that, why that agreement isn't enough to satisfy the president. He looks to sort of fortify our position in the Arctic.
Sure, it's a fair question. I have 3 points I'd like to make. First is that Denmark's part of NATO, was a founding member of the NATO alliance, but they're actually not complying with Article 3, which says that every NATO ally has the ability to defend their own territory. And then Article 5 come to the defense of their allies. The first article I'm referring to is Article 3. It's the defense of your own territory. They've never been able to defend Greenland. In fact, in 2019, my second point, President Trump pressed current Prime Minister Mette Frederiksen in his first term and said, look, Greenland's not secure. We need Denmark to do more. You need to secure Greenland. Look at what's happening, because he has the best intel. She has some of it. And so she committed to spending $200 million to increase the security of Greenland. This was Danish funds to do this. Well, flash forward, she spent $2 million of the 200, so 1%, and it wasn't even on security. So she reneged on her commitment. So he cannot trust anything that she says because she's not credible. Danes elect prime ministers to take care of them and use their taxes for things like social welfare programs, like free health care, free childcare, free college. That's what they want their money spent on. And then third, Greenland's going independent, and no one's talking about that. In the 20th century, Iceland went independent. In the 21st century, and they were part of the Kingdom of Denmark, in the 21st century, Greenland will go independent. The majority of the Greenlanders want independence. And President Trump what he is doing is he is preempting the idea that Greenland would link with China, say, rather than the U.S. when they are part of North America.
But how is he doing that, Carla? I mean, when I hear that they want independence, my first thought is, okay, let them have independence. It's their country. I mean, who are we to go in there? But it also raises the issue about the fact that we've had a formal relationship with Greenland going back to the post-World War II era, a relatively peaceful arrangement. So what I don't understand is if the U.S. thinks that there is a strategic importance for us to be more involved, to have a greater military presence, and maybe even greater control over certain land out there, why not just pick up the phone and talk it over? Why are we rattling the saber at an ally?
Well, we're not rattling the saber at all. It's actually the prime
minister. He just said he would attack them if they didn't actually agree to what he wanted.
Well, she never picked up the phone to actually talk to President Trump in a whole year. All of that, she was going behind his back to talk to European leaders who don't have credible defenses of their own. And she was complaining, and I think she's trying to raise her poll numbers internally. She's underwater. It's
possible. Like, I don't really care about whether she's under polls. What I care about is what the U.S. strategy is going to be going forward. And it's easy to say we have a strategic interest. I think we all know that. The question is, how do you execute protecting those interests in a way that, basically just doesn't wipe out the sovereignty of a people?
Sure. So the Greenlanders want to go independent, but there's only 56,000 of them on a land mass one-third the size of the continental U.S.
Hey, Carla, I'm sorry. We're up against a hard break. We're going to have to continue this conversation in a second. This is Bloomberg.